rushed to tap into their bank credit lines, and that led to large credit line drawdowns. On the left side, you see some anecdotal data. There's no database for this, but S&P tracks from some public filings of large firms how much of the drawdowns were happening, and they went from basically zero during the first week of March, went more than 120 billion in single week, and it continued for about 3-4 weeks. So there was a big demand for cash from large firms especially. Now, if you look at the total credit, at least in the US, the 2008 Lehman crisis period is a good benchmark. At the time, there was a similar phenomenon. The total credit in the economy increased by about 5% within only 4 weeks. So that was a large shock. It was discussed by Regression and Schwarzstein in detail. They showed that the total credit increased, but a lot of it was not new credit going to investment, but it was really the credit drawdowns being utilized. What this time we observed is that, again, this is US numbers only, but within the same 4 weeks of the shock event, which we're centering it around March 11, was a 21% increase in total credit, so more than 4 times higher than the Lehman time. So it was a really large, unprecedented demand on credit, in the form of credit line drawdowns from the firms. Now, these were large, but also they were unexpected by the banking system. So there's some anecdotal evidence here, some quotes from the banks and from other financial sector participants saying that, there was a lot of liquidity in the before period, and banks would offer these credit lines as, as a low-cost opportunity, as a perk to win other business, and they believed that most of them would never be used in full. But it turned out that most companies were drawing down almost all of their allotted facilities, even those who have never tapped them. So Acharya and Stefan looked at similar period, and they report utilization rates of up to 70% at the firm level, whereas the LCR currently says in a stress period, banks should assume a 10% drawdown. So a 10% is a stress period, and a normal period is only a couple of percent, and that's what the banks are prepared for most likely, whereas in this very few couple of weeks period, it went as high as 70%, maybe even higher, as you saw. So during these large drawdowns, what happened is that the positive that came out of this was a liquidity insurance role played by the banks, and they played that role very well. So I don't think we saw any banks fail to provide credit to the borrowers. So in that sense, they did their job. So they provided credit to the real economy when they needed the most, when there was very hard to source cash. But at the same time, the other role of credit provision of new credit going forward, we will argue in this paper that that role was hampered, and the total new credit decline and the standards for credit. So here again, there is some data from the C&I loans, commercial industrial loans from the US. The standard source, so the amount declined a little bit, but particularly the standards were tightened so much that it approached the level of tightening observed the last time during the global financial crisis. So we will argue that these two things are related, although banks met their credit liquidity provision role in a time of crisis. It also affected their financial intermediation going forward for new credit, and especially for small firms. So why is there a tension between these two roles? Through which channels can CLDDS, credit line drawdowns, make banks more cautious in their lending decisions? So the first one obvious to think about is the liquidity drain. These new loans, they are off-balance sheet exposures. When the firms demand it, they need to be funded. They move from off-balance sheet to on-balance sheet. You need to be able to have the funding to meet that loan demand. The second is a reduction is in immediate capital ratio. When an exposure, an off-balance sheet credit line moves to an on-balance sheet, it leads to an increase in risk-weighted assets, and of course leads to a reduction in capital ratios. It is particularly acute for a short-term revolver. It's a credit line that is less than 365 days. It uses a credit conversion factor of 20%. So if it becomes an actual loan, there's a 5-fold jump in the risk-weighted assets, and correspondingly, the capital ratio takes a hit. And of course, it's not just risk-weighted assets. The leverage ratio uses similar credit conversion factors, so the leverage ratio also takes a hit. Now, apart from that, the profile of the borrowers that are tapping on their credit lines could be different than the current profile of borrowers in your own balance sheet exposure. So, for example, you could have wrong-way risk of only the worst borrowers drawing their credit lines, which is not what happened during this crisis, but that's another potential mechanism that could have made banks more cautious. And finally, the uncertainty that these new exposures create. Out of nowhere, you have hundreds of billions of dollars of new credit demand on banks' balance sheets, and it creates potential for future losses. And again, we know that most of these demand came from the industries that were particularly hit in the early phase of the crisis. So that creates not losses immediately, but potential for future losses, which probably makes banks more risk-averse going forward. So they will probably be more cautious in their new lending decisions once they have met this credit line drawdown demand. So the questions we ask are two broad questions. What's the impact of the credit line exposures that bank had going into this COVID phase on their new lending decision vis-a-vis borrowers? And we'll look at supply and terms of the loans. And what are the potential mechanisms, again, the things that I just asked. Why are banks altering their behavior once they met this demand? Because in meeting this demand, they didn't have any immediate problems of the problem. So we put together evidence from four analyses, four data sets. So we try to cover as broad a portion of the loan market, different loans, bank loans, obviously we're looking at banks, as possible. So the first one is from the syndicated loan market, which generally covers, it's a large database of generally large, medium to large corporates, medium to large loans. The second one is small business lendings, but only by US banks. We have more detailed data from the US system. The first one is a global data set, but the second one is only US. It is Y14 data set collected by the Fed. It's loan level data, only by large banks, but it's small business lending, so we covered that area too. The third one is not loan data directly, but it's loan lending standards and terms, the so-called SLOOS data, again, survey of US bank loan offices collected by the Fed. And the fourth data set, or two data sets actually, are coming from the government credit support programs administered by the Fed, the PPP, Paycheck Protection Program, and Main Street Lending Program. So again, we try to cover small loans by small borrowers, medium to large loans, to have a broad view as possible. So today, in the interest of time, I've only selected the 1 and 3. All four analyses are in the paper. I'm going to talk about only the syndicated loans findings and then the SLOOS findings. I thought that would be the most interesting in the short presentation. So let's talk a little bit about the bank's exposure to credit line drawdowns. We tried to construct an ex-ante measure, a potential measure this credit line drawdowns demand once the outbreak begins that the banks were likely to face. So the exposed drawdowns, there is some endogeneity there, so we try to find an ex-ante measure. We look at the credit line exposures that banks had. So for each bank, we look at the credit lines that were originated in the past couple of years going into the COVID period, and they were still on their books as of March 2020. So that's a dollar amount. Again, that's just potentially there. And then we scale those dollar amounts by the total assets. So that gives us our ex-ante measure of CLE, credit line exposure. There is a lot of variation, and this is mostly a large bank business. So, for example, for GSIBs, 8%, the exposure, average exposure corresponds to 8% of their total assets. That's a significant number. For non-GSIBs, it's only 3.3%. So, and again, for US banks, it's much higher, almost 15% of their total assets. They have credit line exposures that correspond to almost 15% of their total assets, where it's less than 1% for Chinese banks, for example. And we see here that actually these ex-ante exposures were very much correlated with ex-post CLDDs. Again, there is no universal data set for ex-post CLDDs, but what we can collect, or in the US, you can get some aggregate data. From there, you can see that they are highly correlated. So using the ex-ante measure is a good instrument, so to speak. Now, so the first set of evidence comes from our looking at the syndicated loan market. So this is a bank, generally a sample of large banks. So this is a global sample. So we are here looking at the intensive marginal lending. We have some results on the extensive marginal lending also. So we look at the CLE exposure and we find that, so maybe to talk about only the GSIB sample. So by the way, so the GSIB sample is where we see the strongest results, and exactly the US GSIBs are where we see the strongest results. Again, these are the banks GSIBs are particularly have high exposure, and the US GSIBs have the highest exposures among all the global banks that we are looking at. So for those areas, we have the strongest results. We see that having higher ex-ante CLEs going into the COVID crisis made the banks more reluctant to lending at the intensive marginal lending during the Q2 and Q3 for all GSIBs, but especially for US GSIBs. So how much more reluctant? What we see is that one standard deviation increase in the CLE exposure, so that corresponds to about 6 percentage points, 5.7 increase in CLE exposure at the bank level, leads to a decline in loan growth rate of about 11.5 percentage points. So again, it's not a huge decline, but it starts becoming economically meaningful at the time when there is demand from borrowers. So we have, again, similar results for the extensive margin. The economic magnitude is smaller there, but we see robustly that the banks that had higher exposures were more reluctant to extend credit both on the intensive margin and on the extensive margin. They were more reluctant to renew loan agreements that were expiring, for example. I will move on to the second data set we have, which is the third one among all the 4 data sets, is the SLOOS, Survey of Loan Officers' Opinions. That was collected throughout 2020. It's collected once a quarter, so it corresponds to the end of the quarter. So the Q1 survey was collected at the last week of March 2020. So that's exactly the time where the banks were being hit the hardest with the credit line drawdowns and with all other shocks related to COVID, of course. So we match them with their call reports and with the deal scan, so we can use their credit exposure. And there are multiple questions that try to keep a pulse on the banking system. The particular questions we are looking at is the lending standards and loan terms. Specifically, the banks are asked, over the past 3 months, how have your bank's credit standards for approving applications for C&I loans or credit lines changed? And also, looking at the terms that you're looking at the loans that you're willing to approve, how have the terms of these loans changed over the past 3 months? And the nice thing is that it's collected separately for large firms versus small firms, so we can see if the banks are changing their behavior differentially across small versus large firms. And they also have a self-reported demand for C&I loans variable that we use as a demand control in our regressions. So here we also see that the higher CLEs are associated with greater likelihood of reporting tighter standards. So it was not only the amount of credit, both on the intensive and extensive margin, but it was also the terms of the credit, bank credit that banks were willing to extend. Those banks that were hit hardest, or they had higher ex-ante credit line exposures, were even more cautious also in the terms of lending. So, and that was true especially for small firms. So for small firms, so one standard deviation increase in the CLEs. In this sample, it corresponds to 35 percentage point increase in CLE, raises the likelihood of tightening to the large firms by 40% of the mean. So all banks reported tightening, of course, in Q1 and Q2. But the result was, in proportion to the average tightening, was even higher for small firms. So when I talk about tightening terms, it's especially for spreads and risk premia. And what you see here is that the effects decline starting from Q3. So the Q1 is really the end of Q1, so please keep that in mind. So the strongest results are in Q1 and Q2. And starting from Q3 and Q4, you see that the results are really declining. So this shock, was it after all really a big shock? Did it stick around? So the answer is that it was initially a large, big shock, but it didn't stick around all that long. And one thing that is being missed, I think, especially not appreciated by many of the banks, is the role of the extraordinary policy support in mitigating the aggregate shock. Now, our results are, especially for the declining credit supply for smaller firms, is consistent with the broader results of Greenwald, Kreiner, and Paul. It's a very recent paper. They look at also credit line drawdowns over a much longer period, over about 10 years, leading and including into the COVID period. They show that credit line drawdowns increase after negative macroeconomic shocks, but that's mostly driven by large firms, and that creates an externality for small firms, and that leads to a redistribution of credit. So we do see an increase in total credit, just like in the Lehman period and just like in the early March, April that I demonstrated earlier. But that leads to a reallocation of credit from large firms to small firms, and that leads to a decline in the aggregate investment. So this redistribution of credit is not without consequences and without macroeconomic consequences. So this is a general trend that they established. What happened specifically during this period was that there was extraordinary central bank support. Starting at the very end of Q1, both in terms of asset purchases and bank credits, central banks step in at an unprecedented rate. So, for example, what Darmuni and Siani is a recent paper, they show that after the extraordinary corporate bond market support by central banks, there was a huge amount of corporate bond issues by firms, and some of these corporate bond issues proceeds went to paying off existing bank loans and paying down their recently drawn down CLs. So there was an initial very large shock at the end of March or April. So Q1, end of Q1 and Q2 was pretty much the shock period. And starting from Q3 and Q4, the shock receded. Firms actually started paying down that drawdowns. And only because there was a huge amount of liquidity injected into the system by the central banks. So thanks to this extraordinary policy support, the credit line drawdown shock was short-lived this time. If it weren't for this extraordinary support, I think we would have had a much tougher period continuing for maybe several quarters going forward. Okay, so I'm kind of out of time, so I'll say something very quickly then that we look at the mechanisms, and what we see is that it wasn't the immediate, what we think is that looking at the responses, again, when you ask about in the SLOOS, the banks are asked what drove their decisions. whether it was the liquidity, immediate capital ratios, and we basically find that it's the higher likelihood of citing lower risk tolerance that was persistent over time each quarter. It wasn't the immediate hit to their capital ratios. Liquidity ratios only initially in Q1, at the end of Q1, that was a reason, but what is standing out as consistent driver is their bank's likelihood of lower risk tolerance. So the CLE exposures and the vast dash for cash made the banks probably created uncertainty for banks, and they weren't necessarily worried about the immediate balance sheet constraints because banks went into this crisis with much stronger balance sheets compared to the GFC period, for example, but they were still worried about the potential losses going forward, having these new additional exposures. So that made them, it looks like that made them more cautious going forward. All right, so that's my last slide. Again, summarizing that after this banks with large ex-ante CLE exposures curtailed the supply of credit, both amount and terms. And this was particularly acute for smaller firms, and those are the more bank-dependent firms, of course, so they are the ones that are suffering, so there's a redistribution of credit within the economy. And this was even true even for participation in government, less risky government-sponsored credit support programs. So it was vast across all loan types. I guess my main takeaway will be that these balance sheets were dormant off-balance sheet risk exposures. They realized unexpectedly. They did not pose the systemic risk that we saw during the GFC time. So they weren't the same level as wholesale funding reliance, for example, at the time, but they still had a meaningful impact on banks' financial intermediation function. And these off-balance sheet exposures did not go away after COVID-19. So we don't see a new push of regulatory push to reduce the banks' exposure, change the regulatory ratios, give incentives banks to reduce. And looking at the data, we don't see a big decline. So they're there. And again, thanks to the large extraordinary policy support, the shock this time didn't have huge persistent consequences, but those exposures are still there. And again, the LCR says banks should assume a 10% drawdown in a stress scenario that was likely calibrated after the GFC experience. But in reality, what we saw is that on average, this was probably much closer to 30%, and at the firm level, it was as high as 70%. So perhaps these off-balance sheet exposures deserve closer attention going forward. Thank you very much.
Thank you, Tumer. So I'm going to move quickly on to the discussion. So I've got Professor Ayadi here, who's, so welcome, the floor is yours. And I would say, just as a full transparency, right, you also sit in our stakeholder group. You chair the banking side of the stakeholder universe for us here at EBA. So please have at it. It's all yours, yeah.
Good afternoon, everybody. Thank you very much, Jacob. Thank you, Tumo, for very good paper and very good presentation. I know that the paper has much more to offer, but you didn't have the time to present everything. Also, I am, as Jacob mentioned, I'm an academic, so I'm chairing the PhD as an academic member. So, of course, the group has different stakeholders and from the academic side. So, first of all, discussing this paper has been really, first of all, I read the paper before because I reviewed it, and I really learned a lot on the behavioral aspect of banks during a crisis situation. So it's really interesting to have this type of investigations that allow us to understand a bit more on the behavioral aspect of banks when there is a crisis like the one we have lived in over the last couple of years. Of course, this is an empirical paper, which means also that more investigations must be done to assert the policy recommendations or the policy ideas that came out of it, and also to better understand what you call the mechanisms, because this is very interesting also to look at it in the, I wouldn't say in the long run, but rather a bit extended period than the 3 months or 4 months that we have at our disposal. So of course, everybody knows that there has been some challenges during the COVID-19 pandemic, social distancing, lockdown uncertainties in the market weighted very much on the economies worldwide in all countries, developed and developing countries over the couple of years, in fact, 2020 and 2021. So it's interesting also to look at the data, or at least at your conclusions during the 2021 data, and even going a bit further. Now, we've seen also some sharp declines in some affected economic sectors. So obviously, it would be interesting to look at specific sectors, whether specific sectors have been really affected more than others. Other economic sectors, for example, have not been affected at all from drawdowns. I think this is also interesting to look at the different sectors that have been affected during the pandemic. Now, of course, there has been disruptions of funding, accelerated credit because of this temporary, I would say, accelerated credit drawdown. And you saw it in the graph, I think in the second slide or third slide you made, that it's only for 3 months or 4 months, not more. And then the situation stabilized once again. So it's interesting to see really what has driven this sharp increase of the drawdown, or for which type of sectors or for which type of companies. And this is something that probably needs to be further explicited in the paper. But of course, let's assume this effect is more than temporary effect. Of course, this puts some pressure on banks in terms of liquidity and eventually in terms of capital. But okay, to drive from liquidity to capital, this needs to be, I think, more permanent rather than temporary. So the timing of this, I would say, dynamic needs to be a little bit more explicited in the paper. But overall, this is a very novel research, which is extremely useful to better understand how external shocks like COVID and even subsequent mitigation policy actions could influence bank lending decisions and implications, of course, financial stability and monetary policy. And this is why these, in the interest of these paper. Now, I think you have already explained very well what is the objective of the paper, so I'll skip that part. But then overall, I think this paper contributes really to better understand banks' behavior in shock situation, and this could be also a useful episode to build the resilience of certain banks in external or extreme shocks. I think this is also an important matter, and obviously it needs to be looked at a bit further beyond the U.S. market. I think this is also my second comment on that specific. On this specific assessment. Now, also you mentioned in your paper that this has also important implication for stress testing and bank risk monitoring. And I think I would like you to elaborate a little bit on that specific conclusion that you made, or you in your paper. Now, seriously, the paper has. It's an empirical paper, so it used a multitude of data sources, but they are all complementary, and it's very wealthy in terms of data. And I think this should be really looked at for other markets in Europe to better understand bank behavior in crisis situation. As you explained, the paper is built on an empirical strategy. I think it's a robust one. And then it constructs a bank level measure of exposure to credit line drawdown risk, as you mentioned. Also, you use the variety of data sets, loan bank level, to establish this link between pre-pandemic credit line exposure and lending decisions. And this is very useful. And also, you try to examine as much as possible these mechanisms by which credit line exposures may affect the lending decisions, using also, very importantly, confidential survey data on bank motivations to tighten lending standard during the crisis. And then of course, the number of observations in a way, they are a bit lower than the overall estimations you made. Obviously, the fact that you have all this set of data, I think you had some data challenges which you explained in the paper, which are the identification challenges that you have, and the results practically you have shared it with us. And clearly, some of the banks, particularly the US banks with high ex-ante credit line exposures, then you mentioned those lines in 2019. This is important. So most probably in 2020, they have increased those credit line or decrease. So it's interesting also to follow, the changes of those credit lines. But overall, they seem to have curtailed the supply of new syndicated loans by the Q2 of 20. But I think it's also interesting to look at the data beyond this Q2. Also, using, as you mentioned, the 2020 Senior Loan Officer Opinion Survey, clearly more exposed banks tightened their standards and terms in new CNI loans and credit lines, especially for, again, Q2, while controlling for the changes in the demand of loans. So this is okay. And then you have other results which are interesting. Again, particularly, you have provided some evidence on the mechanisms behind the negative link from the credit line drawdown risk and bank loan supply, highlighting the importance of changes in the risk tolerance of banks during the pandemic. And this, of course, this risk tolerance depends a lot on many factors, like, for example, the level of capital of banks, the level of liquidity of banks, also how much they were affected to the affected sectors. And I think this is also very important to test in your exploration. Now, my comments are mainly on the data. So this is obviously on the US market. It's interesting to have some comparative assessment to understand a little bit the changes there. But also the period of analysis could be extended. I mean, I think to allow us to have a better assessment on the policy recommendations and the result, or the robustness of the result, I think it's important to extend this period. Particularly that the COVID-19 period has been extended up to 2021. And also tried, because you mentioned global banks, but yes, global US banks, but then it's interesting to assess whether other global banks that are active in the US would have been eventually following the same trends or not. And then again, what is important is to look at the affected sectors and less affected sectors. Now, on the overall structure of the paper, I think the paper will benefit a lot from the expansion of the discussion, the liquidity insurance versus credit provision. I think this is important. This is one of the main novelties in this paper. So probably you need to expand it more and to emphasize what has been done in that level, and how this could be interesting to build the resilience of banks and link this to stress testing, and you mentioned it in your paper also. Finally, and this is also aligned with what I said at the beginning, on the policy results and policy discussions, I think these remain preliminary results for a very short period of time. So it would be interesting to see whether this effect of drawdown is really permanent, or I wouldn't say permanent, but then extended, or it just for a very specific number of banks, which are most probably affected because they are concentrated on some affected sectors, or this is something that if you have the data, it would be interesting to look at. And then also to dig a bit further into the impact of the programs of support to alleviate the impact of the COVID-19, because I was a bit surprised that you mentioned in the paper that this did not really impact much. So it would be interesting to understand a little bit more why this is the case. So this is my discussion. Thank you. And I will send you the slides if you're interested.
Thank you very much. So I'm going to allow for a little bit of time to ask questions to this paper. If there are any questions, please post them in the chat. While we wait for that, then I have one question. So coming my past life from a bank, I think banks do two things when something like this happens, right? Just to be clear. One is that they basically cut down the size of the lines, right? So they basically say to the clients, you had 1 billion before, now you can have half, right? So there's also a measure the banks take to manage their risk, where they basically cut the line sizes. So one thing is that the size of the drawdown ex ante, but what also happens is that you basically make the line smaller very quickly, right? So is that something you've been able to, has that been part of the data set you've had? And to what extent has that been part of the response or the behavior you've seen by banks?
Thank you, Jacob. Yes, actually, so that's the dimension of endogeneity that we also had in mind. We understand there is some endogeneity in mitigating the demand exposed. You have some flexibility. Although these are committed lines, we're looking at committed lines. I understand that there are some covenants that the banks call upon to reduce the line. So that's exactly why we wanted to use an ex-ante measure. So what we're doing is not the actual drawdown amount, but we're looking at the exposure that the bank says. So if it's 1 billion euros, it's the 1 billion euros. In reality, maybe only half of it is drawn actually, or maybe none of it is drawn. But as we showed with the anecdotal data, higher ex-ante exposures are very correlated with exposed drawdowns. It's not a one-to-one relationship, drawdowns are much lower, but they are very correlated. So that's why we're using the ex-ante exposure amounts as our exposure variable. And maybe one piece of additional information is that so the Darmuni from University of Columbia has looked at this, and they show actually that this mitigation mechanism by banks, which is having 1 billion exposure but only giving half of it when it comes to the drawdown, they do more of that to smaller firms, it turns out. So they show evidence that large firms are generally not said no. Their drawdown limits are met, whereas the banks tend to apply that mechanism more towards smaller firms, which actually exacerbates the credit, limiting the credit to small firms in times of need period. So again, there is some dimensional endogeneity, and we are looking at the ex-ante exposure partially because of that. Thank you.
Here, I have one question. Now, given the findings, what do you think about the ability of current market rates to reflect supply and demand, as well as future risk tolerances? Not an easy question.
Yes, that's a tough bit. I mean, so yeah, I don't have a good answer. Sorry. Look, there are many minds here on this conference. I think that's a topic of debate. What I hear is that, yeah, everybody's complaining about the rates in the market. And actually, we were having a discussion and one of the managers of a GSIB in this past year, and they were talking, it was in another conference, there were participants from the private sector participants also. They mentioned that actually they didn't even make much money from these credit lines. Rates are so low that they had to meet this demand. They gave out, billions of dollars, and they charged just a little bit of utilization fee, and they didn't, and a couple of months later, firms paid it down anyways, so they didn't even get to make money. So, yeah, I mean, I don't know if the banks, the rates reflect the supply and demand conditions. We know that it's affected heavily by the policy, and at least banks are not happy. I think I can say that much. Future risk tolerance, I think, I mean, again, just based on my personal discussion, it looks like banks think that they did very well. They think that they can take on the world, but that's missing, I think, the extraordinary support that the banks received from the policymakers. So yeah, I think that the risk tolerance is there until it's not, when they are faced with a large shock. Thank you.
All right, thank you very much. Look, thank you very much, both of you. Interesting paper. Yeah, I think you can expect a slide deck from your discussant who's taken a careful look at your paper there. So good luck with that. I think there's plenty of more work to be done in this area, and I would say do policy suggestion duly noted, sir. Right.